If you observe carefully the markets at the end of 2025, you'll see something that almost no one is discussing with the necessary seriousness. Silver has moved from the $29 per ounce range at the beginning of the year to levels above $70 in December. This isn't just an impressive rally. It's the kind of movement that historically only happens when something deep is breaking in the monetary system. Let me explain why. For over 40 years, I've studied patterns that repeat throughout history. Monetary crises, empire changes, debt and inflation cycles, they all follow predictable sequences. And all these patterns are converging now, with silver at the center of the storm. The question that needs to be answered isn't whether silver will go up or down. The question is, are we seeing the collapse of a decades-long financial manipulation system, or is this just another normal economic cycle? The answer will determine whether you preserve or lose your wealth in the coming years. Today, I'm going to share something that should haunt every American who cares about their financial future. For almost 15 years, banks like J.P. Morgan were convicted of manipulating silver prices through derivative contracts. They paid nearly $1 billion in fines. Traders went to prison. But something changed radically in October 2025. Those same banks that spent years suppressing silver prices are now buying physical metal in historic quantities. J.P. Morgan alone holds more than 700 million ounces of direct and indirect exposure to physical silver. That represents almost an entire year of global production. This isn't a prediction, it's a logical consequence. When you understand the incentives, you understand the behavior, and the incentives have changed completely. History is an excellent teacher, especially when it comes to precious metals and monetary crises. What's happening with silver today isn't new. It's a pattern that is repeated for centuries. Let me show you how. In 1971, Richard Nixon ended the convertibility of the dollar to gold. It was what we call the Nixon shock. The world left the gold standard and entered the era of fiat money. In the following 10 years, between 1971 and 1981, silver rose from $1.30 to $50 per ounce, an increase of almost 0%. Why? Because when currencies lose their anchor to real assets, investors seek alternatives that preserve value. After that, we had 4 decades of systematic suppression of precious metals prices. How was this done? Through the derivatives market. Let me explain simply. Imagine there are only 100 real apples in the world, but a casino allows people to bet on thousands of paper apples. These paper bets determine the price of real apples. This is exactly how the silver market works. COMEX, the main silver futures exchange in the United States, trades contracts representing 300 times more silver than actually exists in eligible stocks. For years, major banks sold silver contracts they couldn't deliver, artificially depressing prices. But every system based on manipulation eventually finds its limits. And those limits are being tested now. And here's the point most people ignore. In December 2025, something unprecedented happened. In Japan and the United Arab Emirates, market reports indicated spot trades above $120 per ounce, while the official price on COMEX was $72, an 80% premium over the paper price. This is rare at this level, and when it appears, it's a sign of fracture in the price mechanism. It's the signal that the paper-based pricing system is breaking. Physical metal demand is exceeding the system's capacity to deliver. To understand what's happening, you need to comprehend 3 fundamental principles that govern precious metals markets. Silver isn't just a monetary metal. It's also an essential industrial input. Unlike gold, which is primarily a store of value, silver is consumed in industrial applications. Solar panels, electric vehicles, electronics, artificial intelligence, data centers, they all depend on silver. The Silver Institute reports that industrial demand reached a record 680.5 million ounces in 2024. Meanwhile, mine production remains essentially stagnant at about 835 million ounces annually. This means recurring structural deficits, which already total hundreds of millions of ounces per year. Deficits can be covered by existing stocks for some time, but eventually stocks are depleted. And that's what's happening now. Precious metals are sensitive to real yields on government bonds. Real yield equals nominal interest rate minus inflation rate. When real yields fall, investing in assets that don't pay interest, like silver, becomes more attractive. In 2025, the Federal Reserve cut interest rates twice, bringing the base rate to 3.75 to 4%. With inflation persisting above 3%, real yields are near zero or negative. This creates an ideal environment for precious metals. Something fundamental is changing in the international monetary system. Central banks around the world are buying gold and silver in record quantities. They're not buying paper contracts, they're repatriating physical metal to their own vaults. Russia announced purchases of $535 million in silver over the next 3 years. China accumulates metal through the Shanghai Gold Exchange. This represents a structural change in demand. It's not temporary speculation. It's permanent strategic reallocation. Markets can be manipulated for some time, but not indefinitely. Let me tell you a story that perfectly illustrates how these principles work in practice. Imagine a country where a single bank controls almost half the stocks of a national strategic resource. This bank spent decades manipulating the prices of this resource through derivative contracts, keeping prices artificially low while accumulating the physical metal. Then, when the manipulation system began to break, this bank completely changed strategy. This isn't a hypothetical scenario. It's exactly what JP Morgan did with silver. Between 2008 and 2020, JP Morgan was investigated, prosecuted, and fined for precious metals price manipulation. Its traders went to prison for spoofing, placing fake orders to deceive other market participants. The bank paid more than $920 million in criminal fines. But here's the interesting part. During all this time, while suppressing prices through paper contract sales, JP Morgan was simultaneously accumulating physical silver. In December 2025, the bank holds 196 million ounces of silver in COMEX vaults, representing 43% of total stocks. Additionally, as custodian of the largest silver ETF, SLV, it controls another 517 million ounces, total more than 700 million ounces. It's the largest concentration of silver in the hands of a single entity in modern history. Now, here's where it gets really interesting. In October 2025, market reports indicated that JP Morgan completely liquidated its short position of 200 million ounces in paper contracts. For the first time in decades, the bank isn't betting against silver. In fact, it shifted to the buy side. When you understand the incentives, you understand the behavior. JP Morgan saw what you and I are seeing now. The paper-based system is breaking. And when a system breaks, whoever controls the physical assets controls the game. Now I'll translate this into terms that directly affect your life and your wealth. If you're an American between 40 and 80, you probably have most of your wealth in 3 categories. Your home, your retirement accounts, 401k IRA, and maybe some stocks and bonds. What's happening with silver is a signal that fundamental changes are coming for all these assets. Let me explain how. Most American retirement portfolios are based on the 60/40 model. 60% stocks, 40% bonds. This model worked well during 4 decades of declining interest rates. But we're entering a different environment. When the monetary system changes, traditional assets may not protect your purchasing power. Silver is signaling that this transition has already begun. When incentives change, behavior follows. Many Americans believe treasury bonds protect against inflation. This is a misconception. Bonds are denominated in dollars. If the dollar loses value, bonds lose too. Precious metals, historically, maintain purchasing power during inflationary periods. Silver's rise is anticipating future inflationary pressures. If you own $500,000 or more in assets, you need to think about intergenerational wealth preservation. Changes in the monetary system can massively redistribute wealth between different asset classes. Those who own real assets benefit. Those who own paper-based assets may lose. The question isn't whether these changes will happen. The question is when. And the signals indicate that when may be sooner than most imagine. In November 2025, CME Group raised silver futures margins 3 times in 3 weeks. This is what happens when a market is under extreme stress. The system is forcing smaller participants out, concentrating control in few hands. This accelerates the transition already underway. Based on the principles we've discussed, here are practical guidelines for positioning your wealth. Most people believe they're diversified because they own different stocks and bonds. But stocks and bonds are both financial assets denominated in dollars. During monetary crises, all financial assets can decline together. Real diversification means owning different types of assets: financial, physical, and productive. Precious metals represent diversification into physical assets. For most people, an allocation of 5 to 10% of wealth to precious metals is prudent. For those more concerned about systemic risks, 15-20% may be appropriate. The typical division would be 70% gold, 30% silver. Silver offers greater appreciation potential, but also greater volatility. Physical maximum protection, but storage and security costs. Convenience, but depend on the financial system that may be changing. Mining stocks, potential for greater returns, but also greater operational risk. For most, a combination of all three may be appropriate. Don't try to time it perfectly. Movements in precious metals can be extremely volatile. The most prudent strategy is dollar cost averaging, buying fixed amounts regularly. This reduces the impact of short-term volatility. The most important thing is psychological preparation. If you decide to include precious metals in your portfolio, you need to be prepared for volatility. Silver can rise 50% in 1 month and fall 30% the next month. Focus on the long-term objective, preserving purchasing power through systemic changes. Nothing in this constitutes specific investment advice. Each person has different circumstances. Consult qualified professionals before making important decisions about your wealth. Throughout my career, I've learned a fundamental truth about markets and history. Systems based on manipulation eventually self-destruct. Gravity always wins. What we're observing with silver isn't just an investment opportunity. It's a reflection of much larger forces that are reshaping the global monetary system. For centuries, global monetary power has changed hands, from Spanish gold to the British pound sterling to the American dollar. We're possibly witnessing the first signs of the next transition. I'm not predicting dollar collapse. Dominant monetary systems can persist far beyond what most expect. But the data suggests that the dollar's monopoly is being challenged. And historically, when monopolistic systems are challenged, the first signs appear in precious metals markets. Silver is screaming a message that few are hearing. The message is simple: prepare for changes. If you observe history carefully, you'll see that the greatest wealth transfers happen during monetary transitions. Those who position correctly before changes benefit enormously. Those who ignore the signals may lose decades of wealth accumulation. The choice is yours. But remember, in history, ignorance has never been a defense against the consequences of systemic changes. Central banks are buying precious metals for a reason. Major banks like JP Morgan changed positions for a reason. Industrial demand is creating structural deficits for a reason. All these reasons point in the same direction. We're entering a period of fundamental monetary changes. And silver, this forgotten and manipulated metal for decades, may be one of the best leading indicators of these changes. The question isn't whether you should pay attention to these signals. The question is whether you'll act based on what they're telling you. Because in history, as in markets, timing isn't everything, but adequate preparation is. And the time to prepare is before everyone realizes what's happening, not when it's too late. And that's why this channel exists. If this type of analysis makes sense to you, subscribe. Here we don't react to market noise, we observe the signals before they become obvious.